and with their 30-day money-back guarantee, there's zero risk in trying it out. In 2008, like most other major nations at the time, Canada's economy started taking an aggressive dive in the wake of the GFC. However, thanks to a combination of a housing and financial market that wasn't quite as overheated as the USA, and resource exports to China, it was not hit as hard as the rest of America and Europe. The country did originally manage to not only bounce back from the crisis, but witness a similar resurgence in the following 2 years. What separates them is that nations like the USA continued to see unprecedented growth, while Canada's ride wasn't nearly as smooth. In fact, it started an extended period of stagnation. After the 2014 oil market crash, Canada has continued to reveal a fairly long chain of troubling vulnerabilities, with a decline that's often been noted as one of the worst amongst developed economies. Among these vulnerabilities is one that Canada isn't necessarily dealing with exclusively, but it's become such a massive problem that it's almost come to define the country's economy, and that is of course housing. Aside from the obvious zoning laws and regulations, the country has made a series of mistakes that made its housing affordability uniquely horrible in comparison to other Western nations, a lot of which can be attributed to lowered interest rates, as well as how they view real estate as an investment. Of course, lowering interest rates is a standard for countries in the wake of a crisis. If nothing else, it's often used as a psychological tool to increase consumer confidence, to avoid the death spiral caused by less borrowing, less spending, and less investment. This, on its own, is stock-standard counter-cyclical monetary policy, nothing that unusual. But it did cause a few problems specifically for Canada. For starters, their housing market never really suffered as badly as the USA during the crash, because although it may be hard to believe now, lending and real estate investing was a lot more controlled in Canada at the time. Now that's a good thing by itself. But when the country lowered interest rates, largely in line with most other advanced economies around the world, it boosted a market that never really felt the correction in 2008. This has over time reinforced the idea that Canada sees housing both as an investment vehicle, one that's never really failed, and as a consumable good for people to, well, live in. As more of the population bought into housing as a wealth-building tool, price increases became not only inevitable, but politically desirable. For some perspective, if an economic good like a dishwasher doubled in value every 5 years, that would be seen as an economic failure, especially now that modern products like this need to be replaced constantly. But when houses double in value the same way, a lot of the population in places like Canada see it as a great outcome because it materially increases their wealth. And yet this cultural demand has led to a situation where a majority of Canada's population are homeowners. So the country could have fixed these problems before they started, increase interest rates, tighten lending rules, and reduce tax incentives for home ownership and investment. But with the majority of the population owning real estate, it's put Canada in a bit of a political vice, especially considering that Canada's housing debt now exceeds its total GDP. Nobody wants to be known as the figure that put an end to the party. Of course, this is clearly not a sustainable system. The value of homes in Canada has seen dramatic increases, with prices soaring more than 300% over the past 2 decades, while median nominal incomes only increased by slightly more than 100% over the same time period. As a result, things are starting to change,